October. Slightly disappointing again for the markets, all the major indices finishing in the red, at least a couple of percentage points. So what's been going on here? Well, for the most part, we have a bit of a good news is bad news type of scenario. US GDP growth came in strong once again, significantly above expectations, so just under 5%, which is also surprisingly high given the overall economic context. But what it does mean as well is that markets now anticipated the central bank, the Federal Reserve, to keep rates higher for longer. That's not good for markets. It means tighter financial conditions, bond yields rose again, and that process then affected the equity markets as well. If you add to this a couple of other factors as well, such as disappointing earnings from a couple of the large tech companies, geopolitical risk in the Middle East, ongoing concerns around inflation, and markets overall struggled in October. As we go into November, however, things are starting to change, at least somewhat. So as we noted last time, our models indicate that this downward trend that we've seen in the markets over the last 3 months or so has been overdone and was likely to reverse. And we've started to see the beginning of this reversal now at the beginning of November. Markets have been oversold and they are likely going to move in a bit more of a positive phase now going forward towards the end of the year. To be clear, this does not mean that all things are rosy. There's still plenty of issues, still plenty of risks out there. That means caution is warranted, but in the short run, things are starting to look up. Hopefully, we could even see a prolonged Santa Claus rally materializing at the end of the year.